Hello, hello, hello. Welcome to Our Stock Trades. Boy, do I, it's been a while since we've been on here. I miss you guys a lot. So why have I been gone for quite some time? Man, it has been hectic at the hospital. This has not only been experienced in neurology, neurosurgery, but it's literally across multiple specialties. For some reason, we've been experiencing a high volume of patients. So it's a little bit more than higher than usual. So yeah, um, been conquering the afternoons and evenings at the hospital, working overnights on call. So it was very fun. But yeah, today's Saturday. I've been watching the computer in the studio every now and then. I'm like, I really want to talk to them, but by the time I get to the computer, it's a little too late. It's like, I don't want to bother them. So yeah, I missed you guys a lot. I can tell you that. I miss you guys a lot. You guys have been part of my daily routine for quite some time. So in this video, what I'm going to do is I have some statistical analysis and modeling, but there's a couple more things I want to look at. So I'm not going to be giving you any of those stats right now, but I am going to be giving you kind of an update on what's happening in the market. This is going to be a 48-hour update. There's obviously 7 days. A lot of things have happened. We're going to skim into some of those, like, for example, the CPI and everything. But this is kind of an update, and maybe some of these things you may have not read, but I'm going to give you guys a couple things here. So Kroger, which Warren Buffett is a fan of, announced it is going to be buying its rival Albertsons for $24.6 billion in one of the biggest deals in the history of the grocery industry. Now, as a tangent for all our mastering stock market students, I always like to do this. Whenever there's an acquisition, I always like to see what is the acquisition price. Then do a normal intrinsic value calculation like you would do normally on a particular stock. Then compare the intrinsic value calculation on what you get with that stock with the acquisition price. And then you can kind of see what's, then you could take that and compare it to others within that same industry. So it's a nice little way to get inside of these big businesses, multi-billionaires, their heads here. Okay. So by combining the two companies, you will essentially gain the greater scale and negotiating leverage while putting them in a position. They want to compete against Walmart and Amazon, right? Because remember, Amazon bought Whole Foods. In fact, it was Albertsons that was considering wanting to buy Whole Foods, but they missed that opportunity, right? So Kroger will acquire Albertsons for $34.10. If it was Elon Musk, he probably would have said, why don't you just do $34.20? But they did the 10 cents here. So do the intrinsic value and see where you would get at. Now, we will assume a roughly $4.7 billion of, they're going to take on $4.7 billion of Albertsons net debt. As part of the deal, Albertsons will pay a special cash dividends of up to $4 billion to its shareholders. So right on to Albertsons, right? And Albertsons was a stock that was recently publicly traded, started around $12 to $13. I remember getting in on that, and I think at that point my target was around 25. But I haven't done an intrinsic value since then. But this was before I came on YouTube to kind of show you what intrinsic value means, right? So Kroger and Albertsons could control about 13% of the U.S. retail food sales, following some, divesting in terms of how they're going to implement this. But the issue here is they're over a certain threshold, which means that they need to obtain regulatory approval. So you may see the stock price not near the $34, but not to worry, because Walmart shares, in terms of its food sales, it's approximately 22%. I'm speaking here locally, but you can kind of think, kind of near you. Do you live near a Kroger? But do you also live near an Albertsons or Safeway? Like for us in the Southern Hemisphere in Tucson, Arizona, I live right next to a Safeway and an Albertsons, and then a Walmart, a little further out, and then a Whole Foods right next to us. And already these are, like, we just talked about this food chain here. I do live next to a Bash's too, like 5, 6 minutes away. Now it's 10 minutes. I don't know who bought Bash's, but I think they just got recently acquired as well. Um, could it be Albert? I don't think so. I have to take a look at that. But as you can see, as from an American citizen standpoint, I don't like when big businesses acquire others because it limits competition. But you have enough right now with Walmart, Amazon, and everything. And then, oh yes, so for Clover Health, we're gonna be making a dedicated video on that, and going through everything that's happened since I've been, MIA, and then we're gonna go ahead and talk about that. But overall, we will talk a little bit about that, more close towards the end, near the Federal Reserve economic stuff. But I will be making a full dedicated video on that one. Okay. So Kroger plans on directing $500 million in anticipating cost savings to reduce prices for its customers. So about $1.3 billion are going to be invested into Albertsons stores. So in terms of bank headwinds, so now we're going to go to the banking sector, okay? Now, major banks and financial institutions, they essentially kicked off their earnings. So in the third quarter, profits dipped as essentially Wall Street's biggest banks in the third quarter braced for a weaker economy and dried up dial making and investment banking. Okay, so J.P. Morgan, Morgan Stanley, Citigroup, and Wells Fargo showed a slide in net income after volatile markets choked off investment banking activity and lenders set aside more funds for loan loss reverses. So we could have seen this, 6-7 months ago. Chase was essentially prepping, and they are prepping for this and weathering the storm. They're sitting on, I believe, over $1 trillion in cash. Now, Morgan Stanley, Citigroup, and Wells Fargo slumped in profits around 30%, 25%, and 31% respectively. So Morgan Stanley 30, Citigroup 25, and Wells Fargo 31%. Okay. And I do want to take a quick diversion here. And I want to show you a diagram really quickly regarding U.S. stocks versus bonds return from 1926 to 2022. First, I have to share the screen. Sorry about that. It's been a while since I've done this. There it is here. Okay, there it is. Okay, so on the x-axis here, you have U.S. stock returns. On the y-axis here, you have bond returns. So now you see stocks are not doing well and bonds are not doing well. Okay. Now, technically, the Treasury with the 4%, but many people that invested in bonds before this whole increase, they're not doing well right now. And this was done. This happened in 1931, 69, and 2022. I'm curious when we're going to start calling it 23s. Oh, the 24s, the 80s, the 90s, right? Because we call these the 60s. And so when are we going to call, you're getting older, huh? Back in the 30s, right? 2030, right? The goal here is many people are starting to reconsider the 60, 40, 70, 30 portfolio between, 60% stocks and 40% bonds. So why is this important? Why am I talking about this? Well, for all of you guys that are learning about the stock market and all of you guys that are here right now dedicating into investing in your human capital, you guys are going to be rewarded for this, because a lot of the whole 60-40 portfolio, the argument now is that still the gold standard? And from what it looks like now, things are changing. Now it's become accustomed, if you go to physicians and lawyers and people that make six figures and above, not necessarily millionaires, you talk to them and you basically say, well, what's your investment strategy? they always say index funds, index funds. And the people that made the index funds have been making fees off of those index funds. On an individual perspective basis, it's not as much if you were to buy an index fund. But the thing is, you know how you want to do the opposite of what people do? Well, we've gotten to a point now where index fund investing has become kind of the new X, Y, and it's become the standard. And when I see a lot of people doing something in Wall Street, um, in the general population, I tend to become a little bit more averse and kind of recalculate and reconsider, um, you know, the playing field of the chess game. Long story short is I don't think index funds are going to be the way to go in the future. I think that an investor needs to understand how to evaluate a business. And I believe optimal returns are going to be rewarded for investors that are able to look at the moat of the business, understand the competitors of the business, understand the people that are managing the business, understanding the financials of the business, the free cash flow of the business, the intrinsic value, the macroeconomics on a smaller percentage scale impacting the business. Okay. So these are the things that I kind of think about. Okay. Okay. Let's go back. So UK, United Kingdom, they're U-turning, pivoting. So UK's Prime Minister Liz Truss has fired her Treasury chief. I'm not going to say his or her name. Quattenage, Kwasi, if you want to read about her or him, to salvage her tenure and amid pressures from the Conservative Party and international markets, aka the US. Okay, so Truss is expected to reverse key parts of her planned tax cuts today as her economic plan to stimulate the United Kingdom into growth unravels after backlash from the financial markets and her own party. Okay. So Prime Minister's plan for the British version of Reaganomics was launched 3 weeks ago. Since then, the pound has hit a record low against the dollar. The Bank of England has stepped in to support the government bond market, and the Conservative Party's support in option polls has tanked to record lows. So tax cuts were prominent features in, Trudeau's campaign here, and a reversal will represent a political disaster for her, right? So the UK bonds have already staged a recovery from last week's lows as markets increasingly anticipate a U-turn on the tax cuts. So when I talk about U-turn, we're already starting to see the UK pivot. And the million-dollar question really is honestly, when is the Federal Reserve going to pivot? And now we're going to turn our way into the economics. So according to the Mortgage News Daily, the average rate for a popular 30-year fixed mortgage climbed to over 7%. Meanwhile, mortgage credit availability is now at the lowest level since March of 2013. When housing was trying to recover from the great financial crisis, I mean, this is some serious damage we have in our economy right now, right? So let me just give you an example here. So 2 years ago, the average 30-year rate was around 2.87%. And the cost of the average new home in the US was $395,000. Now, fast forwarding into today's home costs, we are sitting at $522,000 for that same home. The increase in home prices and mortgage rates represent a jump of 110% for the average house payment. And I'm sure you've seen those little diagrams on Twitter floating around over what's the monthly payment, $2,000 back in, a year ago. And then now it's $3,000, making new ownership of a house extremely unaffordable. Now, I want to, yes. So the labor market, the labor market's extremely strong right now, which is why rent prices have, essentially continuing to increase. Which is why the Federal Reserve is going to try to shut down this labor market and increase the unemployment rate. Now, many of you are saying, what are they doing? Well, they're doing it on purpose because they don't want rent to continue. Again, you don't want a very, no middle class society. That's the middle class. It's not a political statement when the presidents of the United States say that essentially the middle class helped the country. It's true. Without the middle class, there would be no United States. Okay. So another thing I want to add. So there. Yeah, we'll continue. So now let's go ahead and turn into the CPI report. So the U.S. consumer inflation, excluding energy and food, pushed to a 4-decade high last month as price increased to 6.6% from a year earlier, up from 6.3 in August. So that marked the biggest increase since August of 1982. All right. So the overall CPI increased 8.2% from the same month a year ago, down from 8.3% in August. So the housing makes up a large share of the overall core inflation index, and it has risen the most since the early 1980s. So due to the strong labor market I was talking about, this unfortunately continues to push up the rent rates. So for all of our mastering stock market students, inside the owlstocktrades.com website, when you log in, there's going to be a document in there that shows you favorable times to invest and unfavorable times to invest. And one of the criterias within that is the unemployment rate. So look into that. This is from a Warren Buffett standard. Okay. Now, the Social Security Administration announced yesterday that they would be increasing benefits by 8.7% in 2023, again, to offset this inflationary time the United States is experiencing, and honestly, the world economy, really. So the latest CPI print has raised chatter of a 100 basis point hike in November. Now, again, that's just chatter. I personally think it's going to be most likely a 75 basis point increase, another 75, which is a lot, guys. I mean, we're getting up there. Okay, we're getting up there. So yeah, that's pretty much it right now, just to kind of catch you guys up in the market. What's going on with Kroger, with groceries, the banks, the economy. And I hope that this catches up a little bit. Then we're going to switch more to economics, and then we're going to go ahead and do our statistics. And then I believe by this next weekend, we'll do our bi-monthly meetings, but we'll do double time to essentially make up for the time that we have in October, because I had a 4-week rotation in neurology, and by the time you get used to the schedule, I have a new schedule now for internal medicine. I'm doing rotation, which is in 8 weeks, we'll be able to have some normal, a normal schedule. Okay. All right, guys. I love each and every one of you. That was a jam-packed, 18 minutes. I wanted to kind of catch you guys up. I hope you enjoyed this, kind of to see what's going on in the economy, to kind of help you navigate. But you are going to start to see a lot of acquisitions now. It's going to increase, and it's a great time to buy. Now, for Clover Health, we're going to be making a dedicated video. But for Clover, guys, what's interesting here is that I personally thought the market, I am going to be stopping buying shares. I would say anywhere between $4 to $5, maybe, $4 to $5. And I was very fearful that these $2 prices are going to go away from us. And here we are now at $1.50, right? And that is just marvelous, because now every month, from the, I don't know what you guys have in terms of your income from your jobs, rental, housing, et cetera, et cetera. This is helpful because now you're able to essentially double down on Clover, right? So that's what I'm doing, right? Or double down on whatever stocks that you guys like, right? It's a great time to essentially dollar cost average. And it's just this is great. This is great because that $1.50 is definitely undervalued. I mean, we're and this is we're seeing this across other companies now too. So this is interesting here. But the economy is still running. Health care is still strong, and that is not going anywhere. Now we had a discussion about Clover regarding their free cash flow positive and net profitability goals in 2023 and 2024. I personally think the stock market is going to be recovering anywhere in around 2025. I think 2026 will be great, with a little asterisk of China not invading Taiwan. That's honestly the only issue. I think Putin's war is going to slowly come to an end, and I'm speculating here. Once oil prices drop, that is a funder of his war, and the only way I believe that oil prices are going to drop is that we need to let the United States increase its oil production, and we need to invest heavily in oil in the United States to bankrupt Putin and to strategically lower the price of oil. Like we're talking to where everyone wants to buy their oil from us and not Putin. And we can kind of basically, like what Amazon did to Toys R Us or the Bookmans or something. Okay. So that's what I would kind of think from a political standpoint. But, we'll see what the Democratic Party, because they are in charge now, what they conclude. All right, guys, God bless each and every one of you, and I'll see you on the next one.